Usually when we talk about diagnosing a massive problem, like, say, a medical issue, there's this expectation of precision.
Right, you expect a clear answer.
Exactly. You break your arm, the x-ray shows a jagged white line on the bone, the doctor points right at it, and the path forward is clear. It's binary. It's totally visible.
Because the human mind, we really crave that kind of categorical clarity. We want to see the fracture to understand the pain.
Yeah, but step into the world of complex systems like global economics, and that x-ray machine just completely shatters. The diagnostic landscape gets incredibly murky.
It does. You end up desperately looking for a clean white line in a system where the real problems are completely invisible.
Right, they're systemic, they're buried under layers and layers of behavior. And today, we are taking that concept, the illusion that complex, high-stakes systems have these visible binary problems, and applying it to the bloodstream of the modern world.
Which is global corporate finance.
Yes. Because if I asked a room full of people what drives a multinational company's financing costs, they would point to the visible things.
Oh, absolutely. They'd say it's the product line.
Or the quarterly sales. Or, the charismatic visionary CEO dominating the headlines.
And they would be looking at the wrong variables entirely.
Completely wrong.
Okay.
Okay, let's unpack this, because the invisible hand that actually chokes a company's financial lifeblood or, sets it completely free is actually the most boring bureaucratic thing imaginable.
Accounting standards.
Yes.
Yeah.
Just incredibly dry accounting standards. Countless enterprises were drowning in this muddy swamp of expensive financing.
And to understand why, you have to look at the pre-2005 European market.
Right, let's set the stage there. Imagine two companies, one in Germany and one in the UK. They have identical assets.
Literally the exact same type of manufacturing facility.
Same intellectual property, same raw cash flow. Everything is identical. Yet the cost to fund those identical assets was wildly different depending on which side of a national border their headquarters sat.
Because they were trapped by isolated, localized rule books. It's like playing a high-stakes game of poker where every single player at the table is using a completely different rule book.
Oh, wow. How can you possibly bet your money when you don't even know what a winning hand looks like?
You can't. Think about the friction that creates. Capital is inherently agnostic, right? It just wants a safe, measurable return.
Makes sense.
But back then, European finance was like trying to load a massive cargo ship with thousands of differently sized boxes, barrels, and, unsealed bags.
It's a total logistical nightmare.
Exactly. The investors are the stevedores. They have to carefully measure and secure every single anomalous package. That takes time, it creates risk, and someone has to pay for that inefficiency.
And let me guess, they pass that cost directly onto the companies.
Every single time.
Which brings us to the mission of today's deep dive. We are uncovering a lethal blind spot in global corporate finance. Our source today is just phenomenal.
It really is a monumental piece of work.
Yeah, it's an 11-year cross-border tracking study by Santa Clara University scholar Siki Lee, published in the Accounting Review.
And we're using it to look at the 2005 one-size-fits-all mandate that forced the European Union to a single financial language.
We want to understand the mechanics of why capital gets cheap, why it gets expensive, and who really holds the power. And for you listening, we need to establish the emotional stakes here.
Because capital costs aren't just some abstract spreadsheet metric. They dictate whether a business survives, whether it hires 10,000 new workers, or whether it just goes bankrupt.
It is the oxygen in the room.
Exactly. So the core tension we're looking at is this: did forcing everyone to use the exact same accounting rulebook, the International Financial Reporting Standards, or IFRS, did that actually save companies money?
Or was it just a massive bureaucratic nightmare? Because I think your cargo ship analogy perfectly captures the macro narrative politicians were selling at the time.
They promised an absolute utopia.
Right. They looked at the fragmented system and said, we are mandating standardized shipping containers. Everyone uses IFRS.
They promised cheap money and complete market harmony.
But if you look objectively, you have to wonder, was this forced unity truly a gift to investors or just another elite capital harvesting scheme?
That skepticism is what makes this data so vital. Because the divide was brutal. On one side, you had these fragmented national rules causing huge information gaps.
And when investors face the unknown, they demand a higher return, the high-risk premium.
Exactly.
Yeah.
On the other side, you had the unified IFRS promising high comparability, But skeptics were screaming that this was nothing but an incredibly expensive straitjacket forced onto perfectly fine companies.
I mean, if a company is doing great under German or French local laws, forcing them to rip out their internal reporting systems and retrain thousands of accountants is a massive gamble.
A huge gamble. And this wasn't theoretical. The sheer scale of the laboratory secretly constructed is staggering.
Let's get into the numbers because they are massive.
The data stretches from 1995 to 2006. We're talking 1,084 listing companies across 18 sovereign European nations.
Wow.
Yeah, that's 6,456 distinct capital pulse checks.
Over 6,000 individual checks on how the markets reacted to the exact same companies before, during, and after a systemic rule change.
But, and this is crucial, we have to immediately address a massive cognitive trap that policymakers fell into back then.
The voluntary adopters?
Yes. Before 2005, a subset of companies had voluntarily switched to IFRS, and the data showed they thrived. Their cost of capital was demonstrably lower.
Okay, wait. If the early adopters loved the new rules and saved money, shouldn't forcing everyone else to do it be a guaranteed win?
What's fascinating here is the massive difference between self-selection and administrative coercion.
The survival of volunteers proves absolutely nothing, does it?
Nothing at all.
Yeah.
Think about the internal mechanics of a company that volunteers for a complex international standard years before it's required.
They must have a lot of resources.
Right. They have the capital to overhaul IT systems. They have sophisticated internal controls. But most importantly, they did the math and realized they look highly attractive under the bright lights of IFRS.
Oh, I get it. They chose to step onto the illuminated stage because they knew they looked good.
Exactly. But the forced group, the ones dragged kicking and screaming until December 2004, they are fundamentally different animals.
Because if they had a beautiful financial reality, they probably would have volunteered to show it off early.
Precisely. By forcing them, you're shoving them onto a stage they actively tried to avoid. They might be legally choking under the new system because they used local opaque rules to smooth earnings or hide debt.
So setting up a proper experiment requires more than just a simple before and after snapshot.
Way more. And that's why the study uses the differences in sovereign laws across 18 nations to create a massive natural experiment.
We're talking over 1,700 samples in the UK, nearly 500 in Germany, over 300 in Italy, 240 in Spain.
We are using those differences to observe the true emotional panic and relief of the market.
Okay, but let's pause here. How do you actually measure the invisible emotion of market fear? I mean, stock prices fluctuate every single second.
It's chaotic.
Right. So how does an academic read the exact risk claim hiding inside an investor's mind without getting lost in the noise?
That is the big question. And the study uses a metric called the implied cost of equity capital, or COC.
Let's avoid the academic jargon here. Can we just call it the ultimate fear tax?
I love that. Yes, it's the fear tax that investors charge a company before they hand over their money.
So how is this fear tax actually calculated?
It relies on dividend discount valuation models. Essentially, the current price of a stock is just the present value of all its expected future cash flows.
Okay, so the current stock price is public. We all see that. And the future cash flows are basically analyst forecasts, right?
Correct. The only missing variable in that math equation is the discount rate, the specific hurdle rate that balances today's price with tomorrow's expectations.
So the model solves for that discount rate.
Exactly. And that rate is the fear tax. It's the percentage return investors require to take on the risk.
Right, so if I suspect a company's accounting is a black box, my fear goes up. I demand a 12% return instead of a 7% return, just to compensate for the anxiety.
That's the exact mechanical relationship. And to be bulletproof, the study didn't rely on just one flimsy metric. They combined 4 distinct authoritative models.
Why 4? Just to be safe.
To ruthlessly eliminate bias. They basically took 4 different lenses, averaged them out, and translated pure uncertainty into a hard, undeniable percentage.
That makes sense. But there is a glaring macroeconomic elephant in the room here.
The 2005 economic boom.
Yes, the global economy was absolutely booming around 2005. Liquidity was everywhere. So how do we prove that a company getting cheaper funding wasn't just blind luck, but the direct result of the accounting rules?
This is where we bring in the ultimate filtering weapon, the difference in differences, or DD matrix.
Oh, I love the DID matrix. Let me use an analogy to make this visceral for the listener.
Go for it.
If you and I are standing in the rain, we both get wet. But if I give you an umbrella and you stay dry while I'm completely soaked, we know the umbrella works. It's not the weather.
That is a perfect analogy.
So in this study, who has the umbrella and who is getting soaked?
The voluntary adopters of the control group. They already had the umbrella before 2005. Their rules didn't change.
Ah, okay.
The treatment group is the forced adopters. By crossing the timeline pre versus post-2005 with the adoption type, the study perfectly filters out the macroeconomic noise.
Because if the global boom was driving prices down, both groups would see a drop.
Exactly. The matrix locks onto the absolute, undeniable net effect of the mandate. It even strips away company size, stock volatility, and financial leverage.
It hunts down every alternative explanation and just destroys it.
It really does. So after running all this data through the matrix, the baseline models showed a violent shockwave.
The brutal data is finally out. What happened?
The forced adopters saw their cost of equity plummet from 9.24% down to 8.77%.
Wow, a net drop of 47 basis points. Here's where it gets really interesting, because to a normal person, a 0.47% drop sounds like a rounding error.
It sounds tiny.
But in a trillion-dollar global capital market, this is a colossal, life-saving windfall.
It's massive. If a firm rolls over €1 billion in financing, that's almost 5 million euros dropping straight to the bottom line every single year.
It's the difference between building a new factory or laying off thousands of workers. It is a massive institutional dividend.
But remember the umbrella analogy. We have to look at the control group to be sure.
Right. If the new rules were so magical, what happened to the companies that already volunteered to use them?
Their line on the chart stayed completely flat. It moved insignificantly from 8.41% to 8.57%.
Wait, absolutely zero change in 2005.
Zero statistically significant change. And that silence is deafening proof.
It proves the 2005 mandate was a targeted, concentrated strike of efficiency exclusively for those forced to drop their bad local rules.
Exactly. And look at the historical leap this created. Before 2005, there was a massive wall separating the cost of capital between the two groups.
An 83 basis point gap, right?
Yes, but after the mandate, that gap was violently erased. It shrank to a statistically meaningless 20 basis points.
The rulebook literally unified the European capital market overnight.
It did.
Yeah.
But before we celebrate the ultimate victory of bureaucratic mandates, we have to look at the dark side of the data.
Oh, there's a dark side.
Always. Because for some companies, this miracle turned into an absolute nightmare.
Okay, let's pivot there. If a unified standard is so perfect, why did some entire nations miss out on this 47 basis point miracle completely?
Because people naively believe that if you print a beautiful, high-quality accounting rule on paper, the market will just magically trust you.
And the market is infinitely more brutal than that.
Much more brutal. You have to balance the paper rules on the left side of the scale with the actual local legal enforcement on the right.
So wait, the exact same instruction yielded completely divergent destinies based on the local cops.
Yes. This raises an important question about enforcement. In countries with strong legal enforcement, like the UK or Germany, the cost of capital didn't just drop 47 basis points.
What did it do?
It collapsed by an earth-shattering 91 basis points. It went from 9.61% down to 8.70%.
Holy cow, nearly a full percentage point erased just because the market trusted the referee.
Exactly. But in weak enforcement countries, the cost barely moved at all, just an insignificant 15 basis point shift.
That is the coldest, hardest reality of this whole deep dive. The entire miracle of cheap capital only exists if you have the police and the courts to enforce it.
Because toothless rules are waste paper.
Right. Why does a weak legal system destroy the value of a perfectly good rulebook?
The answer is hidden in the darkest corners of human greed. IFRS is a principle-based system. It requires managers to make subjective judgment calls, like estimating the fair value of an asset.
And in a strong system, if you lie about that estimate, you go to jail.
Right. Auditors catch you, regulators fine you, shareholders sue you. But in a weak system, without the teeth of the law, that freedom is immediately hijacked.
Corrupt management uses the flexibility of the new rules to manipulate earnings.
Exactly.
And investors aren't stupid. If they know the referee is blind, they don't trust the score, they punish the company by demanding a massive risk premium.
They absolutely do. Now, to really understand how this works, the study broke down these specific accounting mechanisms into two distinct passwords that unlock cheap capital.
Password 1, forcing open the black box.
Right. How do abstract rules turn into actual gold? By putting a metaphorical gun to the head of a company and forcing them to spit out secrets they used to hide.
What kind of secrets?
Things like real earnings per share or granular inventory costs. Under local rules, they could obscure that stuff.
And when they were forced to reveal it,
In strong law countries, Companies that had a massive increase in forced information disclosure saw their capital costs free fall by an astonishing 160 basis points.
160, that is unbelievable.
It is. By killing the investor's fear of the unknown, they essentially bought incredibly cheap money.
Okay, so that's transparency. What is password 2?
Borderless liquidity.
Ah. What happens when an investor in London can read a Spanish balance sheet just as easily as a local one?
Exactly. Erasing the conflict between local and international rules creates borderless flow. For companies that saw the highest leap in comparability under strong laws, the market rewarded them with a mind-bending 202 basis point discount.
202 basis points. That's over 2% off their cost of capital just because their math is easier to read across borders.
Yes. They effectively eliminated the national borders of the capital market. Money flows to where it can be most efficiently measured.
But this brings us to the ultimate penalty for the weak, doesn't it?
It does, and this is the most terrifying finding, the absolute face-slapping reversal of the entire study.
Lay it on me.
What happens in a weak law country when you force a company to change rules, but because their old rules were already vaguely similar to IFRS, they managed to avoid disclosing any new information?
Oh no. So they adopt the new flexible rules but give investors zero new hard data.
Yes.
I'm guessing their cost of capital didn't drop.
It didn't drop. It didn't stay flat. It actually increased by 33 basis points.
Wait, really?
Yeah.
The market actively punished them for adopting the new international standard.
Yes, aggressively punished them. Investors looked at the situation, saw the chaotic transition, saw the lack of regulation, and realized management was now hiding in the shadows of the new, highly flexible rules.
The uncertainty actually increased.
Exactly. It's reverse selection at its finest. If a mandate increases the opportunity for obfuscation without an enforcement mechanism to prevent it, the market ruthlessly protects itself by raising the price of admission.
That is just wow. But as an analytical observer, when I hear massive numbers like a 202 basis point drop or a 33 basis point penalty, I have to challenge the foundational math.
Of course. Is it just a statistical hallucination?
Right. Academics in ivory towers can tweak forecasting models until they find whatever significance they want. How do we know this is bulletproof?
Siki Lee anticipated that exact critique. The study includes incredibly rigorous self-proof. They threw away the forecasting models entirely for a stress test.
What do they use instead?
The absolute purest, dirtiest metric of market friction, the bid-ask spread.
Oh, I love the bid-ask spread. For the listeners, this is the front line of market fear. You have market makers, institutional traders who quote a bid price to buy and an ask price to sell.
And they make their profit on the spread between the two.
Crucially, they are terrified of information asymmetry. If they suspect corporate insiders know something terrible that isn't public, they widen the spread to protect themselves.
Right. They demand a steep discount to buy and a premium to sell.
So it requires zero assumptions about future growth, no analyst forecasts. It's just real-time transactional friction.
And when the study used the bid-ask spread instead of the models, the results held perfectly. Spreads tightened significantly for mandatory adopters in strong enforcement countries. The truth remained unbreakable.
But what about the self-selection bias we talked about? The fact that voluntary companies might just be intrinsically better, more eager firms.
That's where they deployed the Heckman two-stage model to ruthlessly hunt down and eliminate that bias.
Okay, without getting bogged down in econometric jargon, how does that work?
In short, the first stage builds a model analyzing all observable traits of the voluntary firms to calculate a specific eagerness score, a probability of volunteering.
So it mathematically isolates their intrinsic motivation.
Exactly. Then, in the second stage, that score is inserted directly into the main equation. It actively controls for the firm's hidden internal momentum. And even after applying this ruthless filter, the findings were identical.
Unbelievable.
The forced mandate lowered the cost of capital, but only when backed by the threat of strong legal enforcement.
So what does this all mean? We've traversed European accounting rules and mapped the flow of billions of dollars, but the synthesis of this deep dive transcends the 2005 mandate.
It really does. It reveals the true operating logic of the world.
It's the ultimate exam on how a nation's rule of law dictates its economic bloodstream. You basically need 3 gears to mesh together, right?
Gear 1, high-quality rules. Gear 2, iron-fisted judicial enforcement. Gear 3, ruthless investor protection.
And that equals the holy grail of cheap capital.
Exactly. Missing any single gear causes the engine to seize.
Which brings this directly to you, the listener. You cannot simply copy and paste a first world rulebook into a developing market and expect first world riches.
It just doesn't work.
A blueprint of a mansion won't keep you warm if you build it out of straw.
The environment fundamentally dictates the utility of the tool.
And look, the great European experiment of 2005 is over, but the brutal war between capital and the law is happening right now all around you.
In real time.
We've seen how the invisible shackles of localized rules choked companies and how a 47 basis point miracle was unlocked, but only for those protected by the teeth of strong legal enforcement.
We've impartially laid out the data. Transparency and unification generate immense wealth.
But without a powerful referee, new rules just breed new corruption.
Always.
So, as a professional, a learner, or an investor navigating today's intense information overload, you have to look beyond the beautiful paper rules that companies or governments put out.
You must actively hunt for the enforcement mechanisms.
Ask yourself who holds the referee's whistle. And that brings me to a final provocative thought for you to explore on your own.
Oh, this is a good one.
Think about this. If forced transparency and unified rules only work when there is a loaded gun of legal enforcement behind them, what happens tomorrow?
When AI takes over.
Right. As artificial intelligence begins to standardize global decision-making, it's essentially writing a new unified code for human behavior.
For corporate governance, market trading, everything.
So who is holding the gun in this scenario? Will the algorithmic code itself be the new infallible rulebook?
And if so, in a completely borderless digital world, who exactly is the strong enforcer?
Who is going to keep the market from manipulating that code and punishing us all?
It's a terrifying question.
The X-ray machine is broken. We're back in the murky waters. Something for you to mull over.